After 3 years of rising car prices, the car market bubble is finally popping. At least that's what some people on Twitter think. There are definitely some strong signs that car prices are coming down rapidly, and in today's video, I wanted to break down the data behind the car market, tell you about some of the risks, and also try to figure out when we should buy our next car. First, let's recap how we got here. I'm sure you guys know that the car market has just been a little bit abnormal since the pandemic. There were rising car prices, we didn't have any leverage as buyers, and most of the dealers were charging over MSRP for new cars. In fact, even as of last year, 31% of new cars were still selling for over MSRP, as well as the fact that we had that unusual situation where used car prices were selling for more than new car prices. There are 4 main contributing factors to this, and I wanted to break those down first. Now, it all began in 2020 when we had the pandemic, and then all of a sudden, supply chain disruptions occurred. Cars famously can have between 1,400 and 3,000 microchips as part of their components, and as you know, during the pandemic, a lot of these semiconductor factories were closing down. Since there are many chips that weren't being produced as quickly as they usually were, this led to a shortage of new cars, and thus the supply of new cars was quite low. The second factor that many people overlook is that in general, the population had more access to money than ever. First, there were government stimulus checks across the board, plus student loan repayments got frozen, so many people didn't have to make those payments anymore. And in addition, in 2020, there just wasn't that many places to spend your money. So eventually people were just saving all this money for a major purchase down the road. And because of this, in 2021, since new cars weren't being produced en masse, where did all that demand go? It went to the used car market. If we look at the used car value index from 1997 by Manheim, we can see that it steadily grows at a linear pace. And then in 2020 and 2021, it hits a huge spike and is now coming back down slowly. And this trend is something that we're gonna discuss a little bit later in this video. Now, the increase in used car prices at the time was a weird time to live in, but it all made sense. If you can't get your hands on a new car, then you're willing to pay for a used car that is used, however you can get it much quicker. And if you were a seller of a used car, then you could have taken advantage of this and gotten a premium for the car that you already had, which was a good thing for you. The last factor that contributed to the auto market bubble, in my opinion, was historically low interest rates. So from 2019 to 2022, the interest rates were quite low, which allowed a lot of buyers to get into a car that they probably couldn't afford, but just because they could afford the payment by stretching out the loan term, that's what a lot of people did. The average car loan term is now 68.3 months for new cars and 67.6 months for used cars, which is just over 5.5 years. All these factors affecting supply and demand gave us one of the weirdest car markets we've seen in quite a while, with very frothy prices. However, as of December 2023 and even this month, January 2024, we're seeing that trend start to reverse. Here's the last 24 months of data according to Cox Automotive Group, and we can see that the average listing price of a used car is slowly ticking downward to right above $26,000. Car Gurus even has used car prices down 1.31% over the past 30 days, and depending on the brand of the car, some models like the electric Polestar or the Tesla are down 30% year over year. While the overall number doesn't seem hugely significant, the fact that they are moving downward is a trend in the right direction, and it should continue because wholesale prices for used cars are actually going down as well. According to the Manheim Used Vehicle Value Index, used car prices are down 7% from the previous year, and compared to the peak in December 2021, used vehicle values are down 21%. That's an indication that there's enough supply in the used car market to bring down prices, which should also alleviate some pressures for the new car market as well. Wholesale prices are a really good indicator for us to look at because they typically refer to the prices at which dealers are buying from other individuals, other dealers, or auctions. You can see by this graph here from the Black Book data that the week over week wholesale price changes for the past year or so have been mostly in the negative. Whereas before in 2020 and 2021, the majority of weeks wholesale prices were increasing and in the positive. This reversal of a trend is good for us car buyers because when wholesale prices go down, retail prices tend to follow suit within 2 to 3 months. Not all the time, but they are correlated. That means if you're in the market for a new car, you might want to wait between 2 and 3 months or even up to 120 days before doing so, because the price changes could be significant in the downward direction, and that's a great way to take control of your finances. Another way to take control of your finances is with Facet. Now, I get a lot of emails and comments from you guys asking for me to be your financial advisor, but since I can't do that for everybody and my focus is on YouTube, that's a huge reason why I've partnered with Facet for this portion of the video. Financial planning is traditionally expensive, and as a former financial advisor, I can tell you that firms usually charge you a percentage of what you have invested. Oftentimes, that'll present a huge conflict of interest with what is best for you versus what will make them money. With the Facet membership, you gain access to a team of CFP professionals who, as fiduciaries, are legally obligated to act in your best interest. You'll also have the support of experts across investments, taxes, insurance, estate planning, and more. You'll pay a flat annual membership fee, and investment management is included. Facet is waiving their $250 enrollment fee for new annual members, so check out the link down below or check out facet.com/Humphrey to learn more. Another factor leading to car prices coming down this year is that Cox Automotive expects that new vehicle inventories are going to go back to pre-pandemic levels, which is almost 3 million units available, which is 3 times what the amount was during the chip shortage. As of the latest report in mid-December, the days of supply for new cars climbed to 71 at the start of the month, and inventory is typically measured in that way. It's measured as days supply, and at its lowest in 2022 was around 18 days of new inventory supply. Some popular Hondas, Toyotas, and Subarus actually famously had less than 10 days of supply back then. Okay, so this basically shows us that new inventory levels are coming back to a healthier place, which should slowly give the buyer more leverage because we've been in a seller's market for quite some time. Another reason why 2024 could return some normalcy back to the car market is that elevated interest rates are still here, and while they do hurt the buyer, they equally hurt the dealer as well. According to a Cox Automotive dealer sentiment survey, 61% of dealers said interest rates were the #1 issue holding their business back. In fact, even a domestic dealer reported inventory holding expenses growing from $49,000 in 2022 all the way to $670,000 in 2023, which is a 13x increase. But one thing I didn't quite connect the dots on when I was researching this video is why do interest rates negatively affect dealers so much? Well, what I actually found was that it has to do with how dealers are buying cars in the first place. The term is called floor plan financing. So imagine you're a car dealer and your goal is to sell cars to make more money. When you buy cars from the manufacturer to sell in your showroom, you usually don't pay for them all at once. You'll get a loan from the bank in order to buy more inventory, but this loan isn't a one and done loan like you would get for a house or a car. It's more like a revolving line of credit, like a credit card. This allows the dealership to constantly refresh its inventory by paying off what is sold and purchasing new vehicles over and over. When the cost of borrowing money is high with higher interest rates, that means every car that just sits on your lot for an extended period of time is literally costing your dealership a lot of money. And if you can't sell a car quite quickly enough, what's going to happen is that those holding expenses will eat into your profit margin, and soon you might be underwater on a car. So these elevated interest rates paired with higher inventories and prices slowly coming back down is going to put a lot of pressure on dealerships to sell cars as quickly as possible. So that means if you visit a dealer a little bit later this year and interest rates are still elevated, you have a lot of negotiating power, in addition to the fact that if you see a particular car sitting on the floor for quite some time, you might be able to get that at a really good deal. Now, with all this downward pressure on prices and increased supply, there still remains a lot of concerns for the auto market as a whole. Auto loan debt is at its highest it's ever been at $1.6 trillion in the United States, and the average auto loan balance reached $40,184 for new vehicles and $27,167 for used vehicles in the third quarter of 2023, according to Experian. This has also led to auto loan delinquency being quite high, so 7.53% of subprime loans were severely delinquent, according to another auto report. As these delinquencies happen, lenders such as banks might face higher risk, especially if their consumers start defaulting on their loans. And if this happens at a rate too quickly, this could lead to some instability within the banking system. Luckily for us though, the report notes that, quote, the delinquency rate has been high all year, but has not been leading to a similarly high level of defaults, and defaults actually declined in November. Realistically speaking, auto loan delinquencies haven't been at the same scale at the mortgage defaults back in 2008 at the peak of the financial crisis. That's where 8 to 10 million households lost their homes due to foreclosure as well as default, and the subprime delinquency rate peaked at 25% in May of 2008. Still though, it's something that we need to keep an eye on and just ensure that every month is not getting too out of hand, because if it is, that could lead to some cracks in our economy. As delinquencies rise, the number number of repossessions is expected to increase as well, up to 1.5 million cars this year, up from 1.2 million last year. Other challenges include the fact that people with not so great credit can't even afford a car or can't even get a car unless they stretch out their loan terms to say 84 months. Lastly, I want to say that with the total auto loan debt being $1.6 trillion, while that may seem like a big number, and yes, it definitely is, it doesn't mean that the whole world is going to come to an end. People like to say the same thing about our national debt. Just because our national debt is a certain number, that means our economy is going to implode. With any type of debt, we need to look at how much it costs to actually service that debt and look at the debt relative to other numbers. For example, if you earn $150,000 a year and you have a $450,000 mortgage, technically that mortgage represents 300% of your income. But if the payments are $2,500 a month, that's 30% of your take-home pay, which is entirely in reason. As long as people have a way to continually make payments to keep their cars, that's all that really matters for now. All right, with all this being said, is it a good time to buy a car? I'd say if you're in the market for a new car, definitely wait 90, even up to 120 days before you go shopping, because the trend is still continuing downward and there's a lot more downward pressure than there is upward pressure for car prices. If you are buying a car, make sure it's within your means, and I think there are very few instances in which you should buy a new car, so I personally think that you should almost never buy new. The reasons are pretty simple in my opinion. The first is just depreciation. Whenever you buy a new car, you're basically welcoming 30 to 40% of depreciation on that asset within the first few years. Second, new cars offer rarely enough value for that price difference over a gently used car, and oftentimes the upgrades are quite minimal, so I just like to get a used car that's about 3 to 4 years used. It's still gonna seem brand new when you drive it, and I personally did the same thing. So in 2019, I bought a 3-year used car, and it was basically like brand new for half the price. Lastly, if you don't have a good reason to buy that new car, like let's say your income is just astronomical, you're using it for tax purposes or maybe for your business, then I think you should just stick to a used car. Now, if you are looking for a specific deal, especially this year in 2024, you might want to check out the electric car vehicle market. According to CNBC, inventories for EVs are already starting to pile up, so the average number of unsold EVs on the market has grown to 114-day surplus through November, which is nearly double what it was a year ago. Higher EV inventory combined with the fact that some models still qualify for the $7,500 federal tax credit means that you can probably score a really great deal on an electric vehicle if that's up your alley. All right, with that being said, guys, let me know your opinion on the car market down below. Again, thank you to Facet for sponsoring a portion of this video, and check out my next video on cars right here, and I will see you guys in that video or in the next video. Peace.